the Forbes India Show. Earlier this week, we saw an unusually aggressive Prime Minister Manmohan Singh telling his ministers that they've got to get core infrastructure back on track. No excuses, no question of interministerial turf wars on this. They've got to get infrastructure back. So, is this the wow moment that many optimists about the Indian economy were waiting for? And will we see an end to what we've been calling policy paralysis from here? Joining us here today is one of those optimists. We've got Aditya Puri, Chief Executive Officer and Managing Director of HDFC Bank. Mr. Puri, thank you so much for joining us.
Well,
so is this the moment that you were waiting for when the rest of us were writing off India? Could this be the one wow moment? Because we've had a Prime Minister talking aggressively for the first time in a very, very long time. Or do you think that he's too much of a lightweight to push this through?
I'm not going to start commenting on the Prime Minister. Okay. But let me say, rather than the Prime Minister, the action. Okay. Is this the action all of us were waiting for? Absolutely. Okay. I think, Central, what has been happening is that people have talked too much about the big ticket reforms, which are not as important as getting the basics fixed. So we need to
he spoke about that, power.
Exactly.
And roads.
So since he's got involved, we all know, and we have the highest respect for his capabilities, and he's worked things through before. Since he's got involved, I think the basics would be sorted out, whether it is getting the projects going, what is happening. You know, if you sort out the issues on power, you sort out the issues on you don't have to import iron ore, you sort out some of the issues on food, you sort out the issues on pricing of petrol, I strongly believe that India's structural story is still intact.
Okay. But yet we had, again, the day after he said that, we had the pension, the PFRDA bill not coming up before the cabinet, being deferred. So would you say that that's okay because you've got a presidential election coming, so keep the more controversial things on the back burner and go ahead with things that are within your control?
Difficult than running a company or media or anything like that. So what would have caused that, I don't know, but that doesn't worry me at all. I think if the Prime Minister has said that I'm going to move these things around, I for one, and given the a good start, I think we're almost there. So some of these delays will happen, one in a democracy, two coalition, three in politics as such. But as long as we keep moving forward, within a defined time frame, I think we're all right.
Okay. So let's just I'll ask you to get a checklist out and let's talk about infrastructure and what the Prime Minister spoke about. You've always maintained that funding is not a problem and that there is no viable project that is stalled for lack of money.
Yes.
So what action would you like to see, especially when it comes to infrastructure projects now?
See, the infrastructure projects, you can almost define them. If you see power, it's a combination of, and one feeds into the other, the pricing of power, okay, which is linked to the pricing of coal. So if you're going to get coal more expensive, you have to pass on power. I, for one, don't even think that this affects inflation because a large proportion of India's demand is still being met through diesel. And that's at about 14 rupees, the price. So anything 7, 8, 9 rupees. So if you sort out the price, you automatically sort out the fuel supply issue. That's one part of it. You have to sort out issues on land acquisition if the projects have to come through, if your roads have to come through. You have to reduce the red tape on the ability to be able to set up projects quickly. You have to stop troubling the businessman with 50 different inspectors and everybody asking for his cake. So I think the things that have to be done are more procedural, policy, making it easier, making it clear, making it transparent.
Okay. Dual pricing or a hike on, since you're talking about diesel, or a hike in the in excise duty on cars? What is preferable?
I think preferable would be a straight hit on the head, and that's an increase in the price.
Okay.
Political issues may result in our having to go the roundabout way of trying to get the revenue, reducing diesel consumption through affecting its use.
Okay.
But the preferable route would be a price hike.
A full price hike on diesel. In an interview some time back and I'm going to rewind a bit, to Rhythm Desai of Morgan Stanley, you said, and let me quote you, I believe that even if we do not solve our problems, we can grow at 7.5 to 8%. However, that will be foolhardy on our part. We have the potential to grow at 10%. Last quarter, we dropped to 5.3%. So did that give you a bit of a jolt? Because that's clearly below potential.
Yeah. What I had actually said is even if we don't solve all our problems.
All right, okay.
So when all our problems, what I meant was that, there's so much emphasis on retail FDI. Now, is that really important? Is Walmart going to come and change your supply chain for agriculture? There's emphasis on 26 to 49% of insurance. Is that really that important? There's the issue on what is going to happen on banking. So I'm saying, when I said even if we don't solve all our problems, my presumption was that we would solve subsidy and fiscal deficit and make sure that we also brought in some amount of financial inclusion. So what I really meant was that, if we go through that full quote, was that our potential is somewhere in 9 to 10% if we do everything right. But in a democracy, you're unlikely to do everything right. If we do half right, we should be in a 7.5 to 8%. If we go below that, then we are where we are. So I presume you're coming to the half now.
So this 5.3% really is a result then of the twin deficits, and which arise out of our diffidence in tackling the subsidy issue.
And also, the composition of the deficit. If you take, if you see what the RBI has been saying, a large portion of the deficit is for unproductive uses. So if you see our efficiency of capital has come down from, for every 4 units you used to get output, now it's 5. So because a lot of this is not productive. That's one part of it. And we've also had some dissaving, which has resulted in a reduction in investment. If we get investment going, that's the delta that is required.
I'll come back to investment. And just one interesting factor that has come up over the last couple of weeks is that in a time when we saw the GDP growth slow down to 5.3%, in the last quarter, most companies, if you take an average, have grown top line by about 20%. So how do you explain this as
I have been asking the same questions. I think the IIP numbers are wrong. I think we better get the right thing going. Because if you take most top line, and I asked Crystal the same question, that if you have top line at 20, and if you then figure out reduce inflation, etc., and inflation 8 or 9, that's 11%, and say you have negative on mining at 2%, you should be having a 6.5 to 7% growth. So how we get this 2% and 1% and 4% and retrospective revisions, I frankly don't know.
So you see a silver lining to that cloud?
Not only have they got the high top line, if you see, the good thing is the direct taxes are up, the indirect taxes are up, the customs duty are down.
Well, that could also be because slowdowns, because depreciation is down, because no capex is happening.
Possible. But IIP, definitely we better get a handle on those figures to be more accurate.
You've been a banker for almost 40 years. You've been in Singapore, in London, in Lebanon, in
Greece,
Malaysia. In Malaysia. Is this the toughest time that you've seen for the economy, both local and global?
Not really. You're forgetting the 3 and 4% growth rates.
No, but that was structural. I mean, we were used to it. I mean,
we were used to it. But we were also used to the license raj. We were also used to the banks not being able to do anything. So why am I positive? If you really look at it, when you look at financial services regulation, I think they've freed up most of what they could. There may be some aspects left on development of a debt market, etc. Licensing has gone. There is opening up. So I'm actually, when I look at it half full, I'm just upset that having it all, why we're screwing it up.
All right, we'll come back, and on that point, take a break. We'll come back and find out how we can unscrew all of this after this very, very short break. Stay right there. Welcome back. We're talking to Aditya Puri, the CEO and Managing Director of one of India's largest banks, HDFC Bank, an eternal optimist. But Mr. Puri, what are your clients, your customers telling you? Why aren't they making capital expenditure?
See, capital expenditure, there are multiple issues. Firstly, capital expenditure, you've got to have the demand. And they should be able to see that demand for a foreseeable future. And then, so you will have a public posture and a private posture. So when the public posture seems to be that interest rate determines everything, that's wrong. I think they are concerned about the procedural hassles. Nobody wants to set up a power plant and have it not working because you can't get the raw material. So the clients are saying they would want a fair, transparent, open, and a benign regime as far as inflation and interest rates are concerned. And I think we're making too much of this money going overseas. As a proportion of total investment in the country, that's peanuts. But there are investments happening. I think auto ancillaries are going up, people related to road and construction. So I think there is investment waiting to happen if we can see light at the end of the tunnel and a growth rate somewhere around between the 7 and 8%. But they're waiting for the interest rate, they're waiting for inflation, they're waiting for clearer policies.
Okay, but what are you seeing on the on working capital and consumer credit? Are you seeing any
working capital and consumer credit with inflation is a ball.
Okay.
So as far as working capital is concerned, inflation goes up, working capital requirements go down, margins for the companies go down, but actually margins haven't gone down either. So that's another area where probably demand is not as bad as we make it out to be. As far as the consumer is concerned, we must understand that most people have over a period of time got pay hikes more than the rate of inflation. So consumer demand has held up very, very well. And I must say the transformation that has happened in rural India is phenomenal, and the growth rate there is fine. Are we beginning to see some cracks, very minor, which if you may say, the advance army telling you that fix it, otherwise demand over a period of time, 3, 6, 9 months will slow down? Yes. But otherwise it's held up very well.
Okay. Where are these cracks? Are they sectoral cracks? Are they...
No. This is just the buoyancy and the sentiment. So what happens is, if you don't have investments, you don't have that many new jobs. If you start to see a slowdown, then the rates of increments slow down. Inflation definitely for the urban consumer has had an issue. Surprisingly, not so much in rural areas.
I'm going to ask you that because you have a huge thrust on rural India.
Yes.
Are you getting two different stories from rural India and urban and corporate India?
Yes. Rural India doesn't seem to have a problem.
But on a low base, or what is the...
A low base, no doubt.
Okay.
But that applies to all, the whole country overall, given our per capita. We have a large way to go. And obviously, within that per capita, the lower end was there. But they are starting to get roads. They are starting to get a little more electricity. They are starting to get benefits. And so we have seen, and as you go into the interior and the smaller town, there's a lot of money.
Okay. You have said that interest rates only affect projects and investment at the margin.
Yes.
What's your outlook? How much lower can they drop from here? And banks have passed down about 25 bips of 125 bips that the RBI gave on the signaling rate. So obviously there are structural and systemic issues there. So how are we going to resolve that?
See, the issues are twofold. Interest rates will be a function of inflation. To control interest rates at that level will be what the Reserve Bank does. At this point of time, based on what the policy indications, should the rates have trended downwards a little more than they have? Probably yes.
Okay. But at the RBI signaling level or at your level?
At our level.
Okay.
But the problem, Senthil, is that the deposit rates have not moved. And the deposit rates, as you've seen, all you guys tom-tom that a lot. Deposit growth is 13.8, credit growth is 17.5. So when you have a demand-supply mismatch, all of us are competing for the deposits. So when the deposit rates don't go down, you cannot have full transmission. But the transmission will come, and I'm hoping that we should see it going forward from here.
And how much is the shortfall in transmission, if I may use the word, is because of liquidity? And what is the liquidity position now? Because last week we had numbers that looked surprisingly good.
It's now about 90,000 crores again.
Okay.
90,000. I am a strong believer, Senthil, that rather than change policy rates, the Reserve Bank should infuse liquidity into the system.
Okay.
So 1.5% cut in CRR would actually get you about a 50 basis points reduction in interest rate, largely because if the economy doesn't pick up, then there's not that much demand for assets. And then you have demand-supply mismatch on the other side. So today, assets are growing faster. The reason why, even though the Reserve Bank said in its monetary policy that money supply would grow by 15%, is growing by 13.5% odd. So when you have a slowdown, money supply at 13.5%, current accounts get affected substantially. So your total cost gets affected. So if we had ample liquidity, you could see very quickly the interest rate cycle change.
Okay, exchange rates. How much, in your opinion, has the dollar overshot against the rupee?
Tough to say. Let me say it has overshot.
Okay.
And just inflation differential somewhere in the 52 to 53 is probably the right level based on the inflation differential that we've had and the interest rate consequent interest rate differential over the last 2 years. And anything beyond that is probably overshoot.
And how much of a concern is that? Because of course we have people saying it's great for our exports, but then we are a net importer of...
I think you've got to break this into short term and long term. In the short term, it is a big concern. Because when you say exports will go up, exports don't go up in the short term. That's medium term. Could be 6 months, could be 9 months. And I do believe exports will go up during that period because a lot of our competitors haven't had that drop in exchange rates. But in the short run, given the fact that there's a current account deficit and the capital flows are not enough to meet that deficit, it's a concern. Demand and supply will imbalance and you will always have an overshoot. There again, I think if we got some flows coming in, I don't know why the gold thing was reversed, because that would have reversed the demand-supply issue to some extent, and oil prices at 100 or thereabouts. I think exchange rate will come in that 50 to 52 if we get these things right. If we don't, I think we have an issue, and it's important that we recognize in the short run we have to control imports. Get the iron ore. We have iron ore. Why the hell are we importing iron ore? Get the coal.
Get the coal, yeah.
Yeah. Do whatever we have to do for gold, and see what's happening. Reduce subsidies so that your petrochemical consumption goes down. That will have to be done.
Okay. So that's on one side. But how about capital flows? What's affecting capital flows more? The situation around the world, or situations and circumstances peculiar to India?
Situation around the world should be positive for India.
Unless there's a flight to safety, which is so...
No, there again, short term, long term.
Okay.
If you look at it, and this is my view, I'm not anyone.
Yes.
That when you talk to the investor center, they are waiting because your structural story is sound. If you look at Europe, it's not going to grow for the next 5 to 7 years. The US will have tepid growth. I think we don't need to do much to get back to a 7% growth rate. If we get to a 7% growth rate, I think capital will flow, both FDI and FII.
So with the 7% growth, will automatically assume you'll be adopting policies that are right.
Exactly, and that you will achieve your medium and structural potential. And we have lots of talk about, what happened to Vodafone and what happened to GAR and what happened to this. When you talk, because these are isolated issues at the fringes, it doesn't affect most of the investment coming in. So I did ask the Cisco guy, John Chambers, that would this affect you if you had 7% growth? He said no.
No. So it's on the margin.
It's on the margin.
Let's talk about regulation in your industry. At what stage are you now? Is regulation positive enough for you to now really attract a large part of household savings into the banking sector, or are we still seeing lots of money being kept out of the formal financial sector because of regulation?
No, I don't think regulation is keeping it out. I think the money that the Indians have a bias towards gold. There's nothing you can do. I mean, you shake an old grandma, you'll get a couple of tons of gold coming out. So Indians have a bias towards gold. There are a large portion of people that actually don't even trust a formalized institution and put it under there. There are competing products that the government is offering, whether it's a tax-free bond or the national small savings. So I think, while a lot is made about the proportion of people that do not have access to formal banking, we are only about 15% more than the US. So whereas I don't want to say that we should not make progress, but there is no country that has everybody accessing the organized financial market. So I think regulation is not affecting that.
Okay.
We may have issues in terms of whether the banks can finance the growth of the economy a bit more. Well, if the government borrows a bit less, we can do that. That's got nothing to do with regulation, unless you call SLR and CRR regulation.
Okay. Mr. Puri, thank you so much for joining us. Thank you.